Now we're going to look at the profitability ratios. How profitable are our sales? The first one we're going to look at is the operating profit margin. This is earnings before taxes and interest divided by net sales. So this is our operating profit. The next one we look at is our net profit divided by sales. Then we're going to look at return on total assets, which is net income divided by total assets. And the last one is return on equity, which is net income divided by common equity. So now let us look at the calculations using the numbers of AmerisourceBergen. Okay, the operating profit in year 2012 was $1,252,728. The sales were $79,489,596. So the operating profit was 1.6%. In 2011, the operating profit was 1.5%. This is a very, very thin margin. Very, very thin. This means that they're taking 2 cents of every sales dollar to the operating profit line. And out of that, they have to pay taxes and generate net income. Now, if you'll notice, the firm has a very high cost of goods sold. So they're in a very low margin type of business. And this seems to be consistent from year to year. Now, if you were going to look at perhaps Microsoft Corporation, you would find an entirely different type of operating profit figure because they're in a very high margin type of business. So management has to be very, very careful and manage their expenses because they have only a few dollars of their sales dollars to cover expenses and generate a profit. Again, it requires some very, very good management. Now, net profit is the amount after taxes. And here you'll notice that it's a very small number, and it's the same in both years. 1/10 of 1%. So this is a very, very small profit margin. Again, indicating they're in a very, very highly competitive type of business. The next is a return on total assets. Here we're going to look at the net income divided by the total assets. So what kind of a return are they getting on these assets? 4.7 in both years. Again, because we have a very low operating net income to the total operation compared to our total assets, we have a very small return. But again, I want to emphasize that when we look at the total assets, they're mostly tied up in inventory and accounts receivable. There are very few dollars tied up in fixed assets. And again, you need to relate this back to the other ratios to make a comparison and evaluate the success of the management of this operation. Return on equity. This is very important to a shareholder. What kind of return is management generating for me as a return on my equity? Well, these are very staggering numbers, 29% and 25%. So what you're doing here is you're taking the net income and dividing it by the shareholder equity. They had an increase between 11 and 12. This is a very strong return, and it means management's doing an excellent job generating profit based on the dollar amount of equity. This would be very attractive to an investor. Now we're going to look at market value ratios, and there are two of them: price earnings ratio and price to book value. Price earnings ratio is an indication of how the market is converting the earnings per share to a stock price. And the price to book value compares the market price, the amount that a shareholder is willing to pay in the open market for a share of stock, to the book value of that share. Now, AmerisourceBergen's market price at the end of 2011 was $42 a share. At the end of 2012, it was $70 a share. It almost doubled. The earnings per share in 2011 was $2.54. This is arrived at by dividing the amount of net income by the average total shares outstanding. So it was 16.5. In 2012, their earnings per share had increased, but the stock price had gone up. So the multiple went from 16.5 to 25. What happened here is during 2012, the investors were willing to pay a lot more for a share of this stock because they felt there was an indication that management was going to generate higher earnings per share in the future periods. Now let's make a comparison here. In 2012, the average earnings per share for New York Stock Exchange firms across the board, all the stock companies traded on the New York Stock Exchange, was 16. So you can see they were trading much higher than the average. Again, it shows that shareholders are anticipating increase in their earnings. Now here's what is staggering, is at the end of 2014, the price per share was $125. So it had gone up another $55 between the end of year 12 and the end of year 14. So again, investors were placing a lot of faith in the management of this company to generate profits. And if you recall, they're working on a very, very small margin. So this takes them a very astute and very focused management to be able to generate these kinds of earnings and return to the shareholders on these very thin margins. Now the price to book value, we take and divide the shareholder market price by the book value. So you'll notice in 2012 our multiple was 7.3, and in 2011 it was about 4. And the difference is caused specifically by the fact that the stock increased in value from $42 a share to $70 a share. So in other words, this means that the stock was trading at 7 times the book value of the share. And if you remember, the book value of a share of stock is the stockholders' equity divided by the average number of shares outstanding. Tremendous different multiple here. So they're very optimistic about the future of this company. And by the way, this company has continued to grow and acquire more companies, and it's become very, very profitable, and again, it's driven a lot to shareholder wealth through good management.